Hi, this is R Sundar, and today I am going to talk about synthetic future. Before going to the main topic, let me tell you a few other things. In India, there are so many option sellers, and the greatest advantage for option seller is that they don't have to pay the margin money to the exchange in the form of cash. So they can give in the form of collateral. Usually people invest in debt mutual funds or Bharat bond, and they give a collateral. So they get some return from the collateral as well as from the trading. So this is one thing. Coming back to market, there are two things people can do. Either they can play in options or they can play in futures. So what are the differences? If you trade in futures, you have to pay margin money. If you trade in options, if you are a seller of option, you still have to pay the margin money. So there is no basic difference between these two. Both people have to pay the margin money. However, you take a position today in futures, and tomorrow if there is a loss, that is called MTM loss, you have to pay that MTM loss only in the form of cash. Your MTM loss cannot be adjusted against the collateral in case of futures. Whereas in options, if there is an MTM loss, you still don't have to pay the loss in the form of cash. Your loss can also be adjusted against the collateral. So that is the big difference between futures and options. But however, the loss can be adjusted against the collateral as long as you are not booking the loss. I am talking only about the MTM losses. MTM losses can be adjusted against the collateral. So some people have all their money in the form of collateral and they trade only in options. Suppose if they want to trade in futures, is there a way without having any MTM loss problems? Yes, and that is what synthetic future is all about. Instead of going long in future or short in future, you can create a combination of option strategies which will have exactly the same effect as futures. The advantage is that you don't have to pay the MTM loss. You want to go long in futures, normally what you do, you go long in futures. Like let us talk about Nifty. You want to go long in Nifty, what you do? You go long in Nifty futures. You can either go long in Nifty futures or you can go long using synthetic future. And the idea is you simply buy at the money call option and sell at the money put option. Listen carefully, you buy at the money call option and sell at the money put option. This effect will be exactly same as long in futures effect. Can we go short using synthetic future? Yes. You can go long in future, short in future. The same way in synthetic future also you can go long and you can go short. Just now I told you how to go long, buy at the money call, sell at the money put. For going short is exactly the opposite. You simply buy at the money put option and sell at the money call option. So I am going to show you how these things work. Look here, this is the option chain. I am choosing 25th expiry, that is monthly expiry. And before going to this, I am going to show you the futures contract. If you look at the futures contract, the June month future, previous close was 10,118 and last price is 9896 and the previous close is 10,118. So, how much market has fallen? 10,118 and 9896. The market has fallen about 222 points. Yesterday, the market was around 10,100. So, if you wanted to go long, what you should have done? You should have bought 10,100 call option and sold 10,100 put option. And look here, what has happened to 10,100 call option. 10,100 call option, there is a loss of 107 rupees, and 10,100 put option, there is a loss of 112 rupees. You remember here you bought, so therefore 107 is a loss, and here you sold it, so this is also loss. So your total loss is 112 plus 107. So in future it is showing 222 rupees loss, and by doing this combination of options it is showing a loss of around 219. There may be 1 or 2 rupees difference, but that will also be getting adjusted over a period of time. So you see, you have a choice to go long in future, and today the market has fallen about 200 points. 200 points is almost equivalent to 15,000 rupees per lot. If you have gone long in future, you would have paid 15,000 rupees as the MTM loss. But instead, I go long in synthetic future. So market has fallen 15,000 rupees. I still don't have to pay that 15,000 rupees in the form of cash. That 15,000 rupees can be adjusted against my collateral. So this is the biggest advantage. Let us say somebody wanted to go short. It's just exactly the opposite. If you have gone short in future, you would have got 222 rupees profit. But look here, you would have bought at the money put option, there you get 112 rupees profit. At the money call option you would have sold, you get 107 rupees profit. So the total is around 220. Now, what is the big difference? So first thing, I explained to you the difference between going long in future or synthetic long, or going short in future or synthetic short. What are the advantages? You go long in future or go short in future, your STT, stamp duty are much higher. You know your STT, stamp duty, they are all calculated based on the contract value. Let us say Nifty is around 10,000, lot size is 75. So 10,000 into 75 is about 7.5 lakh. When you go long or short in future, your STT, stamp duty, they are all calculated based on 7,50,000 rupees. So that is a big problem. The charges are very, very high. Same thing, instead of going long in Nifty future, if you have gone synthetic long, just now you have seen call option about 200 rupees, put option about 200 rupees, 200 plus 200, 400 rupees. 400 rupees into 75 is only about 30,000. So your STT, stamp duty, transaction charges, everything is based on 30,000, not based on 7.5 lakh rupees. So in a way, putting it simply, you go long in future, whatever the charges you pay, I pay the same charges when I go long in 25 lots, not one lot, because 25 30,000 only equal to 7.5 lakhs. So this is one very, very, very great advantage. Your charges are very, very little compared to futures. Go long or short in future, only margin money can be adjusted against collateral. MTM loss you have to pay by cash. But whereas in synthetic long or short, there is no such problem. Even if there is a loss, it can be adjusted against the collateral so that your entire capital will be getting the return from the collateral. Market may come down today, then it may go up another few days. So that's a different thing. You are going long or short, you are taking a view of the market. I'm not talking about the profit and loss. I'm talking about the charges and the MTM. Futures contracts are traded only for 3 months. So this is June, July, August. Only 3 months contract only traded. Let us say I want to go long in futures in the December month contract. Is it possible? No. Because the contracts are traded only for 3 months. Then what I have to do? I buy in the August month future. Then when come in the end of August, then I have to sell that future in August, buy it in October. So if I want to go long in December, I cannot go long straight away. Go long now, then you have to roll it over 2 times or 3 times. But then every time you have to pay STT, stamp duty and everything. But there is a way you can go long in Nifty futures even in December contract. That is very simple. You know options are being traded in December contract also. Let us say you want to go long at 10,000. You go and simply buy 10,000 call option in December and sell 10,000 put option in December. That is equivalent to going long in December future. Or you want to go short, simply buy at the money put option, 10,000 put option, sell 10,000 call option. That means you are short. So even 6 months, 7 months, 8 months ahead, you can go long or short. You don't have to worry about the MTM losses. You don't have to worry about rolling over the charges. So that is another biggest advantage. So if you want to go long or short in 4 month expiry, it is not possible. But it is possible in synthetic futures. The next question, can we do same in stocks? So my reply, it is not advisable to do in stocks. Why? Number one, you want to go long in December, stock options are not traded for 6 months, 7 months. Stock options are mostly illiquid even in the second month and third month. Only the current month there will be liquidity. Second thing, you take a synthetic future and market move violently on one side. So your one side stock option will be deep in the money and which may not have liquidity. So liquidity issue is a main issue, but no matter how much you are in the deep in the money, Nifty options will have no problem in liquidity. So when the markets move significantly, one leg of the synthetic future will be deep ITM and stocks deep ITM may not be having liquidity. However, highly liquid stocks, you can consider taking synthetic future long or short. So I hope I have given a very, very interesting and useful future for you. So from now onwards, if you want to go long or short, do not go long or short in Nifty futures and go long or short using synthetic future. You save STT, you save stamp duty, you save transaction charges, there is no headache of MTM losses, and you want to go long or short in December contract, you can do, and you have plenty of advantages. So this is the beauty of synthetic future. So thank you for watching. So next week I will come out with another interesting video. Thank you.